Welcome to the first Think Wealthy webinar. And we're going to be discussing our deal flow and deal intake and how we at Symphony Capital Group vet real estate investment offerings, ultimately so you can see as a passive investor really what goes into finding great deals and great projects. So welcome everyone. Thanks for joining us early this morning, at least early here on the West Coast. So wherever you're tuning in from, thanks so much. Glad to see everyone coming in here. So let's jump in, Jeremy. I don't waste anybody's time. I want to get into this morning. So welcome to our Think Wealthy webinar series. And the goal of these series simply is to just kind of continue to kind of open up or kind of pull back the curtains behind what goes on at Symphony Capital Group, so that you, as as a passive investor, or maybe you're trying to become an active investor, you can see what goes on in terms of putting on real estate deals. We would love your feedback. We want to continue to educate our investor community so that they have more confidence to do more deals with us, to continue to build wealth together. And so this is just one of those series. And so if you have feedback or you have other topics that you'd like to see us produce or talk about, please email us and please let us know. We'd be happy to continue to just put out good content that is helpful. So Jeremy's going to be leading this one this morning. Specifically, we're going to be talking about our essentially our deal intake and what goes into essentially green lighting, or what we call red lighting a deal. As a matter of fact, we greenlit a deal yesterday, and we're making an LOI this morning. So this is kind of very much relevant to even where we're at right now. So my name is Ellis Hammond. I'm one of the principals at Symphony Capital Group. Jeremy is another principal at Symphony Capital. Symphony Capital Group is a multifamily investment firm. We're based here in San Diego, and we are essentially buying large multifamily deals across the country. We have closed on just over $100 million of multifamily product since last year, and that's across 4 different assets alongside us and our co-GP partners. And so if you're interested in investing alongside of us, you're a accredited investor, then you can go to symphonycapitalgroup.com and then click that ready to invest button up there that you see. And so if you're not getting our deals and you're not seeing opportunities from us and you want to start seeing more opportunities, please make sure you go do that. Jeremy, without further ado, how you doing, man? Good morning.
All righty. Not too bad. Coming at you live from Austin, Texas. About to go into our asset that Ellis mentioned over down the street tomorrow. So really excited to be here and just continue to tour this beautiful city. I don't know why Ellis invited me on for the first episode kickoff here. I'm going to do my best not to bore you guys, but this is why we have Ellis as well, an amazing host, and really to get a little peek behind the curtain about how we do things here at Symphony Capital Group, to educate you guys, answer questions, and hopefully just learn along the way. Of course, the phone goes off right as we are starting to come in a hotel room, so please ignore that. To give you a little bit peek behind the curtain of how we kind of do our intake deals and go over today our market analysis and submarkets. We're not going to go too deep today. We're going to go more of a 40,000 foot level, and then from there, feel free to ask questions, and then in future episodes, we'll be breaking down these things into the more granular if there is a desire to do so. As Ellis mentioned, a little bit about his background. My background has been in commercial real estate lending. I've closed, originated, and lent, and also managed loans upwards of $450 million. Those were primarily ground-up development loans to sponsors and borrowers in large core markets across the U.S., hospitality, multifamily, industrial, some self-storage as well. So these are the types of deals that I looked at as a lender, and along the same vein, kind of stumbled into multifamily and figuring out that, hey, looking at these deals, a lot of these operators are doing extremely well, and multifamily is something that I personally found to be some of the more risk-averse asset classes out there. And so I've been doing this for a few years now. Got to team up with some great folks like Ellis and Bradley and Keith along our journey. And as Ellis mentions, we've scaled recently into several assets now across the US. So I'm going to go ahead and kind of just go through a high level. From a high level perspective, how we look at markets is first the population size. We want to look at markets that have at least 500,000 people or more. We want to make sure that the population is growing, and we want to make sure that median household income is growing. Those are sort of the three first criterias that we look at. Beyond that, we look for crime in schools, but those aren't necessarily the deal killers. So, for example, Kansas City, Austin, Houston, and San Diego are all four markets in which we have currently invested in with some limited partners. And two of those states, three of those cities meet the more tenant-friendly, landlord-friendly bucket, whereas we're doing some deals in California, specifically San Diego, because it is our backyard. But we were not looking to scale a large portfolio in California, more so in the red states like Texas, like Missouri, like Kansas. I don't know if there's anything you want to add to that, Ellis.
I guess I'd like for you to touch just briefly on why tenant friendly environments are key as a passive investor, and maybe even part of their due diligence process when kind of vetting real estate opportunities, especially, I mean, it's what we look at as well. So why would that be significant to a portfolio?
I mean, as we've seen throughout the pandemic, especially as the government's come in and created these laws across primarily the blue states, California and New York, where I'm originally from is New York, and I know a lot of operators there. They kind of start changing up the rules and changing the game. You can't evict tenants. You can kind of squat there for months at a time, and it just makes it more difficult for your investment to cash flow. I'm not, in terms of a business return environment, we just prefer to go into those cities and states that are more landlord and business friendly, because there just are always uncertainties in other areas where we're trying to invest and grow a business. So it's not to say we would never look into California or San Diego, but if we can do so in our backyard and be there and physically manage it ourselves, then we have a little bit more comfort with that. Primarily our focus is in those other areas that we mentioned. So going beyond just the market, the MSA, obviously then you break it down into the submarket. Each MSA has tons of neighborhoods. If you're not familiar, what we do is we go out and we tour the markets ourselves, but first we'll look at it on paper. Technology these days, we use screening tools such as CoStar, Neighborhood Scout, Yardi Matrix, the list goes on. But to get an idea about where population is projecting, about what jobs and employers are coming into these markets and submarkets, that's really where we get a sense of who can afford these rents, where are rents and just general prices going for the cost of living. We never want to out project or perform what people can afford. At the end of the day, we primarily target the light to medium value add space of the Class B. More recently, we have gotten into Class A, just given the environment. But to get it more granular, each block, especially where I live in San Diego, and if you are live in a city, you can tell and know the fact that things change from one block to another. So knowing those and talking to local brokers or property managers, leveraging those boots on the ground relationships as we've done through our co-GP relationships is really a way to avoid a poor submarket that might not be in the path of progress. So always trying to target those mediocre assets in a strong or emerging neighborhood. Beyond that, as I touched upon earlier, crime in schools, something that we look for, especially if the unit mix is more geared towards families. We'll definitely hone in on the crime in the schools. Not a deal killer when for certain property demographics, but something to keep in mind. Just don't want to be in that path of a war zone potentially. So just good to know, and while you're vetting sponsors, that they're kind of having all these filter criterias as we go through, and they're not just nilly-willy picking at different markets and shotgun approach, because our goal long-term is to build a portfolio and a concentration within these markets to create economies of scale. So what other tools and resources do we sort of use? As I mentioned, we use Neighborhood Scout. We use a tool called ArcGIS, CoStar. After we get a deal in and we are talking with the broker or partners, we'll typically get what is called a trailing 12 or a rent roll. This is kind of the snapshot of where the business is today, and then also where the asset has performed over the past 12 months. So typically you'll get this from the owner or the broker. And what we use or implement at Symphony are tools such as kind of this automated underwriting software tool called Click AI. Essentially what you do is we upload these documents, typically Excels, sometimes PDFs if they're really mom and pop owned, sometimes they're handwritten. I joke and I say the rougher these documents look, potentially the more opportunity, just because the institutional folks know what they're doing and they know what their assets are worth and what they're going to try to get top dollar, whereas we can sometimes negotiate and figure out win-wins with more mom and pop owners. So we use that system to pull in all of this rent from all the units. Typically these are 100+ unit properties, and doing it manually can take hours. So we'll start with the rent roll. Simultaneously take a look at the T12 or that profit and loss statement if you're in other businesses and are familiar with that term. It'll give us kind of a trailing 3 month, a trailing 1 month, and a trailing 12 month to take a look at. This is how the property has performed. Where can we maybe increase revenue or other income? And then where can we be more efficient with management? Let's talk to local property managers, third-party PMs who have maybe 1,000+ units locally in that area. So after we kind of put all this through our pre-underwrite process with one of my partners, Keith, who will be touching upon this in a future episode, we then go to that full underwrite, which takes a lot of time and several hours, and where I spend most of my day. Won't bore you with that stuff too much today, but to go back to that inflow process and intake process from the brokers and from our partners, where we specifically focus and are vetting the deals are across a few different buckets that I touched upon earlier. Are we looking at Class A, or are we kind of looking at the Class B and C heavier value add? We've done a couple different deals here at Symphony where we'll take, for example, our Class A deal in Houston, where it's new construction, 2020 completion. And the way inflation has gone these past 18, 24 months has been incredible, where the developer leased them out at a certain price, but today the organic rent has increased 15+%. So having a deal like that is nice, and it's just a different theory and thesis compared to a heavier value add like we have in Kansas City, where we're putting $7,000, $8,000, $9,000 plus into a unit, bringing them from way below market to where the market is again today, with that organic appreciation that we've experienced there over the past couple of years. And that's more of a faster term, maybe a flip, where we go to sell in 2 to 3 years. Different business plans. One's more hands-on than the other. One might be a longer hold than the other. At the end of the day, our alignment is always with our limited partners to make sure that we're providing them the communication monthly, the distributions quarterly when there is the cash flow to provide, and also the best returns at the end of the day, while simultaneously in this environment finding the next deal for them to recapitalize those proceeds into. So wanted to also touch upon a little bit about partnering on these specific deals from local experts, as I mentioned, property managers, but also local partners and experts, code general principals like ourselves, and then also the relationship side of how we set up these businesses in order to get to where we are today. Because a lot of folks might tell you that this business is easy, and if they do, they're lying. It took us a couple of years of setting up these processes, and my background, just probably should have given it a little bit further in the beginning. Before I was a lender, I was a McDonald's franchise owner operator with my father in Manhattan, New York City, where we managed about 300+ employees across 7 locations, and really worked in the operating side of the business. So I've helped inside of that P&L, that profit and loss statement, what we call in multifamily a T12, kind of turn those things around and streamline expenses. So I think unless you've sort of gone through the trenches and have had real life on hands experience, it's best to start partnering if you're just getting into this or looking for those sponsors with experience, those who have really done it before, turned around businesses and added value in this space. So when you're looking at sponsors, whether it's Symphony Capital Group or you're looking at different deals, we're always available and ready to help out and answer any and all questions. We pride ourselves on communication. And part of why we're putting these Think Wealthy webinar series together is to help educate you guys more and thoroughly. And hopefully one day we can either partner on a deal or come in the fold and work alongside us as a limited partner investor. So
Yeah, that was awesome, Jeremy. I mean, clearly, I think the goal and for you guys to see is just how much we go into every property. I mean, this is it takes a team and it takes a tribe for sure. I mean, these are it moves fast, and so a lot of this is I think the biggest pushback I get, and the only thing I would add, I was just sitting with an investor the other day, and he said, I like the model. The model. I like the fact that I can be passive. He's like, the trade-off is that, if I'm going to share my returns, then I'm probably taking a lesser return. He's like, that just seems like the trade-off. And I'm like, well, the better analogy is that you're probably trading passive. You're passive. You're trading it for control. I would argue that most investors are not trading upside. And the reason is because we're in such a competitive real estate market that every deal right now, the margins can be razor thin, and that, especially any market that is on kind of being listed. Here at Symphony, we look at so many deals every single week, every single month. We have the deals that we're looking at in the market. We have the deals that are being brought to us by other partners. What I said to him is that I would argue that your returns might even be better, even though we're taking kind of 20% of the upside. We typically do an 80-20 split here at Symphony. And so I do think it's something to consider, right? Is kind of what is that threshold from a return perspective that you're looking for? I always say if it's not 30-40% a year, I'd rather be passive and take something that Symphony might be able to provide. So I do think that's maybe a misconception that just because you're passive and we're splitting upside 80-20 that you're taking a lower return. I think with as many deals that we're looking at and making offers on, that we're able to see much more, kind of a much larger set of deal flow and really be able to provide the ones that are focused on bringing you the highest and best return. So I'm not saying you can't go find great deals yourself, but I'm saying this is it takes a lot to really go find great deals in this market, and
I
I'm really
think
grateful for our team
to
for this.
that point, I'd say that the most valuable resource beyond the return and the monetary percentage of ROI, if you will, IRR, or however you measure it, is the time. Because we're looking at, I don't know how many, probably I can look at our Monday dashboard and see we probably looked at 200 deals before we actually close on one. So just imagine the amount of time that it would take to go and do this and set up I would say, I'd argue it takes at least a few folks to set up your team and to get this going, because to do it on your own, it's feasible, it's possible. It might take a little bit of capital to hire the right folks and surround yourselves with people who have strengths in areas that you might have weaknesses. But the time component, time freedom, like Talis's point again about these returns, which are still pretty strong. And that's what we're looking to provide here at Symphony. Take as much risk off the table as we can and provide great deals in great markets.
For those of you who are here, if you have questions you'd like to either raise your hand and ask yourself, I'd be happy to let you ask from I can turn your audio on and unmute you, or feel free to type in the chat. Be happy to answer any questions here. As I'm waiting for questions, I'll kind of give you an update on where we're at right now and kind of the markets that we're focused on and what you can expect from us. Symphony Capital Group will have a deal in Q1. There's no doubt about it. We have two very strong LOIs out right now. I would say it's likely that one, if not both of those LOIs get accepted. And if so, that means we will have an offering in front of you in the next 2 to 3 weeks. None of those offers get accepted, then it might look more like March timeline. But it's very, very likely that Symphony will have an offering in Q1. And the markets that we're focused on right now are Dallas, Texas, Kansas City, Missouri, and San Diego is another market that it's not one of the markets we have a strong LOI in right now. And so those are the markets that we're kind of aggressively pursuing. So Texas, Kansas City, San Diego, that's where you can probably see more opportunities from us this year. Probably most of those deals are going to be 506c offerings, so for accredited investors only. However, we may still have one or two offerings this year for non-accredited investors. So if you do see a 506b offering come through for non-accredited sophisticated investors, make sure you jump on it with us, because those will probably be fewer this year than they were in 2021, just because we're taking down larger assets, and we're going to need to we need the marketing power behind us to be able to raise the capital. So that's why we are going to begin to kind of make a shift towards 506c type offerings, accredited only. So again, I'm looking at a lot of names. I recognize a lot of these names. It's great to see you all. If you're not registered on our investor portal, please take a moment to do that at symphonycapitalgroup.com. And if there aren't any questions, then I will let everyone get out of here. Jeremy, this was fantastic, man. Thanks for taking the time. Anything you would like to add or say before we jump?
I think just in terms of future episodes, we'll probably dive into more of the intake and all the way through to LOI high level, like I mentioned, and potentially get into the weeds. We want to show investors and potentially future partners the process that we go through to really the amount of time that it takes. So that way they know when they're investing with us that we're looking at all these parameters and criteria. So that's really what we're here to do, beyond just the educational portion. But again, I touched upon enough for today. I'm sure we'll get a little peek behind the curtain on the next one. So I'm excited to get this going.
All right. Thanks, everyone. Have a great day. Cheers.
Yeah.